Hello, I'm Corey Raifstenger for the Guardian Life Insurance Company of America. Have you heard of Harry Markowitz? Probably not, but I bet you're familiar with his work. He's a brilliant economist that came up with the idea of asset diversification. He actually dubbed it modern portfolio theory, and anyone that followed that methodology in the recent market downturn is pretty happy that they listened. In this 20-minute video segment, you'll hear industry consultant Dick Weber talk about diversification, meaning you put your money into a variety of investments within different asset classes, such as stocks, bonds, and fixed income. And we'll take a look at how life insurance can be used during your lifetime, not just at death, as well as the intriguing opportunity to include life insurance as an asset class in addition to your investment portfolio. Of course, we're not suggesting that life insurance is an investment, because it's not. But when appropriate life insurance products are acquired for lifetime use, incorporating them into your overall financial portfolio can produce some intriguing and beneficial results. After a 42-year career in various areas of the life insurance industry, today Dick works on behalf of consumers and their advisors to help them better understand, appropriately purchase, and then manage their life insurance policies. Dick and his business partner Chris House have recently written a research paper entitled Life Insurance as an Asset Class. And we've asked Dick to discuss with us some of the highlights from that paper that we felt you would find interesting. We're pleased that this research has been awarded the Academy of Financial Services 2008 Best Paper. Not to be overly personal, Dick, but were you diversified when the big drop in equity values began in 2008?
Well, I don't mind answering that. I wish I'd had my crystal ball back in late 2007. My personal retirement plan's 50-50 asset allocation did help my wife and me from losing as much as those who were completely into the market. One of the long-standing tenets of successful investing is the idea that we should diversify our investment opportunities rather than putting all our eggs in one proverbial basket. While there always seems to be a few who are skilled enough or perhaps just lucky enough to make a killing by putting all their money in one investment, the typical investor's chances of success putting all their eggs in one basket is probably even lower than letting it ride on the double zero at the roulette table. That's especially true today.
Not putting all my eggs in one basket. That reminds me of advice my grandmother gave me. So does that mean with a little bit of cash she could have been the next Warren Buffett?
Well, very possibly. But I think one thing the current economic situation is reminding us is that the basic lesson of investing for the long term is still our best protection against short-term disaster. Not putting all your eggs in one basket is a very good idea. We all know that the market slump that began in early 2008 has been especially harsh. The stock market fell almost 40% as measured by the S&P 500. But did you lose 40% on all your investments? You didn't lose on cash in FDIC-insured accounts, and your investments in U.S. Treasury bonds probably gained some value. Many people diversified their stock portfolios in bonds and other fixed income securities that were affected only slightly by the market drop, or perhaps not at all. If you had your investments allocated in the most common asset classes, meaning cash, equities, and fixed income securities, whether you knew it or not, you were following Harry Markowitz's Nobel Prize-winning modern portfolio theory. Markowitz's approach to moderating the exposure to risk with asset class diversification is one of the most important and relevant economic theories developed in our lifetime. Individuals who use modern portfolio theory invest in a custom mix of asset classes whose market value tends to move in different directions when influenced by things like higher or lower interest rates or an expectation of a souring economy. So let me give you an example. You wouldn't be well diversified if you bought 1,000 shares of Sony and 1,000 shares of Panasonic, even though that seems logical diversification, because the downturn in demand for consumer electronics affects both companies the same way. Now, on the other hand, if you were trying to hedge your concern that oil prices may or may not return to historically high levels, you might consider some junk auto stock offset by an investment in gas-free transportation. So you might buy Schwinn bicycles or an investment in gas-sipping motorcycle stock. Using asset classes that aren't generally related to each other in terms of how they react to the markets also helps to balance desired returns with the amount of risk you're willing to take. This was a paradigm-shifting approach. In doing this type of diversification, the volatility of the resulting portfolio will be less than the weighted volatility of the individual assets. So we're trying to lessen the potential that in a down market it's all going to be going down as if sucked up by a vacuum cleaner. If you followed this concept of diversification, hopefully you've avoided some of the worst effects of the current bear market by having less volatile bonds offset what turned out to be extreme volatility in equity stocks. Modern portfolio theory deploys diversification of asset classes in an attempt to achieve the best risk-return ratio, that's a phrase we'll use, risk-return ratio for your unique needs and aspirations, lifestyle, financial situation, and personal preferences.
So are you saying that modern diversification can shelter us from the kinds of market turmoil we've been having lately?
Well, not even Markowitz figured out how to avoid losses entirely, but his adherents have been able to moderate the broader losses. In the last 80 years or so, we've seen market increases in excess of 50% in a single year, and we've come close to the same figure on the downside. But individuals tend to lock in on index results. They tend to forget that a stock index doesn't have to represent our entire portfolio. The first step is to identify asset classes. Most advisors agree that the primary asset classes should include cash, equities, and fixed income investments, and we also hear advisors considering guaranteed income such as annuities, real estate, and even gold and other precious metals as additional asset classes. That's a term of art. The next step is to diversify assets among and within these classes in order to offset both what we'll call systematic risk, which includes things you absolutely can't control, like recessions and interest rates and inflation, and the unsystematic risk, those which are related to individual stocks, businesses, or industries. Yet no matter what precautions are taken, we need to be careful not to assume we're earning more than we really are. Consider that even in a double-digit bull market year, when stock prices are consistently rising, returns will inevitably be diminished by volatility, inflation, taxes, and fees associated with the investment process. From 1977 through 2006, total equity returns of these large capitalization stocks, things that are measured by the S&P 500 index, reflected a nominal compounded annual rate of return of 12.27%. And that's a very big number as a compounded annual rate of return over 30 years. Many equity investment decisions have been made over the last 30 years with that attractive gross average return in mind. Yet with the effect of taxes and investment fees, plus that time period's compound inflation rate, the real compounded rate of return of the S&P 500 over that 30-year period of time was a net of just 5.19%, less than half of the gross.
Interesting. Those more realistic after-tax and after-expense numbers suggest to me that lifetime uses of life insurance might have a place in this conversation.
Absolutely. Until very recently, the notion that life insurance should be considered a distinct asset class would have received very little attention. Of course, it's important to keep in mind that life insurance is not an investment, it's an insurance product. But the recent global economic downturn and resulting uncertainty do suggest that we look at all the opportunities that we have to minimize risk and maximize long-term returns, what we'll say is the modern portfolio way. And certain types of life insurance allow us to do just that. Our research suggests that when life insurance is considered for lifetime purposes, a permanent, and for this discussion, we'll use what we call whole life, an insurance policy can be an ideal vehicle to integrate into a portfolio as an asset class of substantial value. Needed permanent life insurance incorporated within an investment portfolio of mixed asset classes can produce at least as favorable a long-term result with less risk than an equity and fixed income portfolio without life insurance.
Dick, your white paper had some interesting graphs and examples. Would you walk us through those?
I thought you'd never ask. What I'll show you first demonstrates the value of integrating life insurance within a fixed income portfolio rather than purchasing additional bonds. The following example evaluates the growth of a $500,000 initial investment from age 45 to age 90. This first chart shows that the investment in bonds growing at an assumed constant 4% rate of return over the years would accumulate an asset value of roughly $2.9 million. The second chart compares the results if the $20,000 initial year's bond income was used instead to purchase a whole life policy against the results of an all bond option. In this analysis, during the first 19 years, the all bond option produces slightly higher accumulations than the blended bond life insurance cash value alternative, but after that, the values utilizing life insurance rapidly increase, outstripping the bond-only portfolio in the later years. This coincides with the years when an individual may want additional resources for income, as inflation and cost of living could outpace what Social Security and a pension might otherwise pay out. Because the life insurance death benefit is paid in full at death, no matter what the timing, the legacy value of the bond life insurance combination delivers a significantly greater result every year, as we might anticipate. Taking it one step further, we'll assign a generally accepted numerical risk factor to owning a 4% coupon municipal bond, and we'll customize a similarly calculated risk factor for both the guaranteed and non-guaranteed portions of a participating whole life insurance policy. As you can see in this last graph, a higher return with reduced volatility or risk is produced by life insurance purchased for lifetime uses when compared to the fixed income portfolio simply buying more bonds. This is due to the synergy of funding a life insurance policy from the income stream produced by the bonds, achieving the ideal sought after through the application of modern portfolio theory. Finally, as I've done in the Buy Term and Invest the Difference video, let's look at the dual considerations of supplemental retirement income and the desire to leave a financial legacy as the basis for my mathematical assessment. To plan and provide future retirement income, many people rely on employer-sponsored plans, investments, and life insurance. As retirement draws closer, many financial professionals recommend scaling back on riskier investments and increasing an investor's allocation to fixed income investments. What you see here evaluates a 45-year-old's $500,000 municipal bond as a component of the fixed portion of the portfolio and its ability to maximize retirement distributions as well as enhance the legacy value at life expectancy. I'm going to show you two strategies around that. The first one is letting an initial $500,000 bond investment compound in value by reinvesting the bond's annual income, and we could, at the end of the period, have almost $1.1 million to turn into interest-only retirement income of $42,137 a year beginning at age 65. Because we're only drawing down income, the principal of $1.1 million will be the legacy value of this strategy whenever death occurs. Now let's talk about strategy 2. It, by contrast, takes the bond's annual income and buys however much whole life death benefit can be purchased with the bond's natural income of $20,000 a year. You see that there's slightly diminished bond value on the chart at age 65, and the reason is that we took $20,000 up front out of principal, even because the bond's income isn't paid until the end of the first year. So that plus the cash value of the policy is essentially the same $1.1 million compared to the first strategy. By letting the policy's dividend pay the policy premium beginning at age 65, and drawing down interest and principal from the bond, along with some cash distributions from the policy, We can increase the retirement cash flow by almost 20% and provide almost twice the legacy value at death, and all this with a slightly lower risk index.
One of the things I like about the strategy you just discussed is that by diverting bond income into a separate asset class, the whole life policy, rather than reinvesting the proceeds into more fixed income investments, we've added another layer of diversification.
I think that's a good observation, and it's a good point in the current phase of our historic up and down equity bond markets. Somewhat prophetically, Fidelity Investments in 2007 produced a brochure entitled Target Asset Mixes, implying an important but subjective component of risk, the degree to which fluctuations in the market value of portfolio investments will keep the investor from, as they said, sleeping well at night. We can all identify with that. This problem has certainly been experienced by investors in these recent times, and it's a real issue that keeps many individuals on a more conservative investment plan. So this sentiment puts conservative participating whole life insurance once again in our line of sight for its unique ability to combine the lifetime use of life insurance within our investment portfolios. Corey, I think you would agree that most of us seek reasonable returns to enhance the value of our invested assets, especially those earmarked for retirement. And at the same time, most of us are a little gun-shy today after losing up to 50% of the value of the equity portion of our retirement-focused portfolios. At the same time, many of us have a real need for life insurance due to its ability to provide cash at the death of a wage earner or estate owner. As we've discussed, diversification is critical for a well-thought-out portfolio, and an individual's risk profile and time horizon are both important considerations when making investment choices. With the ability of permanent life insurance to serve as a low-risk, reasonable return asset within a well-diversified portfolio, I think we can confirm the lifetime use of life insurance as a qualified asset class, providing the ideal capstone to a solid, balanced financial strategy.
Dick, thanks again for sharing your wisdom and personal experience. I really appreciate your insight on portfolios in general and the integration of whole life insurance as I think about my own investment strategy. Of course, you may have your own unique circumstances that should be evaluated against these generalizations, but I can say with confidence that speaking with your Guardian representative will help you to achieve the life insurance strategy that may work best for you, so that you and your beneficiaries will be appropriately protected both now and in the future. We hope that you will join us in our next segment, where we will talk to Dick about life insurance illustrations. They're a valuable tool that can help you understand the many benefits offered by permanent life insurance products.